Hey, what's up guys? John here. State Farm, California's largest home insurer, is requesting a combined 30%, near 30% increase on home insurance.
State Farm was allowed to temporarily raise home insurance rates, the biggest insurer in California asking regulators for additional rate increases.
California Insurer Commissioner approved a 17% rate increase, while now State Farm is asking for an additional hike to bring the company closer to the original 30% increase.
Now, when you look at where we've come the last several years, it's pretty shocking around real estate. Record low interest rates in 2021 encourage people to borrow money, put 3.5, 4, 5, 10% down on a $500,000, $600,000, $800,000 purchase. Everybody thought things were going back to normal, and borrowing money was free money. And so a lot of people borrowed to the gills, not realizing that insurance, taxes, everything would continue to get more expensive. The cost of living would get more and more expensive. You look at where mortgage rates are right now, everything is signaling a major shift in certain states.
Today's housing market is pricey and competitive. The supply of homes for sale is low, and prices are 53% higher than they were 5 years ago. Mortgage rates, which have more than doubled since 2022.
California, Florida, Texas. And when you look at what they're saying happens next, not just in those states, but nationally, it's going to repaint the picture of where it's smart to invest in real estate, where the risk really lies, and where the opportunity really lies. California, I believe, is a beautiful state. Florida, Texas, beautiful places to live. But owning property there on a shoestring budget is going to be very risky. And let's face it, in an expensive location like Los Angeles, most people own on a shoestring budget. Even people making $200,000, $300,000 a year are tapped out in most cases. Leveraged to the gills, paycheck to paycheck. Look at this. This came out 5 days ago. California approved State Farm's 17% increase in home insurance premiums in the wake of LA wildfires, right? Then they're asking for an additional increase just 2 hours ago. State Farm asked to increase California insurance prices again. And what they're saying is California insurers, State Farm, is asking regulators for another rate hike less than a week after it was granted permission to temporarily charge an extra 17% for homeowners insurance policies. The company, the largest home insurer in the state, wants the California Department of Insurance Commissioner Ricardo Lara to approve an additional 11%, so a combined 28% increase for homeowners. How are people going to afford this? Imagine being a multifamily landlord, having debt that you need to roll over this year or next year. You have to refinance your debt. At these interest rates, with this insurance market, it's a problem. So whether you're a first-time buyer or a leveraged landlord, it's an issue for a lot of people. And I believe we're going to walk into a really big shift because of this issue. So you have all these articles, by the way, coming out the last 24 hours. So Newsweek, this came out today, May 20th. Then you have this yesterday. Climate could drive surge in foreclosures and lender losses. Now, I think what they're really saying is lenders are going to become even more stringent on whom they lend money to, and it's going to get harder and harder to get loans. Now, when you match that idea up with what Jerome Powell said, which is it's going to be very hard, nearly impossible to get mortgages in high-risk states. He said this just a couple months ago.
Both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. If you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, there won't be ATMs, the banks won't have branches and things like that.
He was mainly talking about Florida, Texas, California, Louisiana, states like this. Everything is making a lot of sense. So extreme weather linked to climate could spell financial ruin for many American homeowners and lead to billions in losses for lenders. Now, you have taxes, property taxes and insurance essentially doing a rug pull on Americans' wealth. 70% of Americans have their wealth tied into their home. So when you have taxes and insurance continue to go up, backed by higher mortgage rates, it's a really big issue. First Street, a research firm that studies the impact of climate, projects an analysis released Monday that foreclosures across the U.S. caused by flooding, wind, and other weather-related incidents could soar 380% in the next 10 years, right? And so they give this, this survey showing how much it's going to lead, how bad losses are going to be. And for every 1% increase in insurance costs, the firm projects roughly a 1% increase in the foreclosure rate. Now, CNN came out yesterday, same time, saying while climate could affect your credit score for buying a home, climate should be considered a new core aspect of creditworthiness when prospective homebuyers apply for a mortgage, a new report suggests. The analysis from the climate risk financial modeling firm First Street is the groundbreaking nationwide look at the ties between growing risk of extreme weather such as floods and wildfires and a long suspected spike in mortgage defaults. Now they go on to say that even if you apply for a home loan, have great credit, but apply for a home loan in an area that is viewed as very, very risky, it could impact your credit score. It finds that lenders and borrowers are exposed to more financial risk than they are aware of because of current ways of determining creditworthiness, leaving out exposure to climate disaster as a factor. If climate risks were taken into account by lenders, which the analyst shows may be increasingly necessary as climate worsens the severity and frequency of certain weather events, then the next time someone goes to get a home loan, their credit score could be knocked down or adjusted upward due to the climate risk exposure. At the same time, mortgage lenders could become more hesitant to provide policies or raise the cost of borrowing in certain risk areas, greater exposure to climate-related hazards. So you can see what this is going to mean. California, Florida, Texas, these are going to be all cash markets. All cash markets, and I believe we're going to see a lot of these mom and pop landlords get wiped out next decade inside of these areas. And I believe we're going to start to see a really big shift towards the affordable markets the next couple of years. I think that's going to be the future. You have tens of millions of retirees in a really bad spot. You have a lot of Americans in a real bad spot. You got 35% of Americans working remote. I think we're going to see a lot of Americans leaving America as well. And all of this around housing and the cost of living is going to, push people into change. I think it's going to be very comparable to what we saw in 2020 and 2021 when a lot of people left New York and California, went to Florida and Texas and and Tennessee. Well, now this is what they're projecting the rates are going to be. Summary table, estimated average annual premiums for 3 to 350,000 dwelling coverage. Now, if you're buying a house in LA, it's probably 800 grand at least. So you're going to have coverage that's likely going to be more than this. But they're saying projected in the next 5 years. In Florida, they're saying $22,000 to $23,000 a year is what they're projecting. High end, they're saying 25 to 26K. Texas, 65 to 6,800. California, 35 to 3,800. Now, again, this is for a $300,000 policy. I'm not sure where you're going to get a decent house in LA, or really any house, and have a policy for 300 grand. The cost to build the house is probably 200 bucks a foot at least, probably 250. If you have a 2,000 square foot house, you're talking 450 grand just for the structure, right? You're going to have a much higher policy than this. Now, what I believe is going to happen is they say here, in the housing market, and again, this is all the last 24 hours, that they're saying everything is about insurance going up. When they say that you're not going to own much in the next 5 years, I believe housing, when people don't own their house, most people don't own their car, they're financing, they're leasing. When everything gets more and more and more expensive, it's going to get more expensive to finance these vehicles. Everything is going to follow with it. And so those that are making smart decisions right now in their business with their money are going to have a lot more opportunity in the future. In the housing market, homeowners insurance has become the embodiment of the effects of climate. Over the past several years, more frequent and more expensive severe weather events have strained insurance companies, even skyrocketing premiums to punish homeowners' wallets. Now, new research proves what many observers have assumed, but rarely qualified. Insurance does shield homeowners from financial troubles in the wake of weather disasters, but existing guidelines for coverage are nowhere near adequate for the scale and scope of potential perils. Even more concerning, insurance costs may soon become too much for homeowners to afford. Now, when you look at everything unfolding right now around inflation and the projections of inflation, well, the cost of everything is going to get more expensive. So they're telling you insurance is going to get more expensive, but what they are not going to tell you is how much more expensive it's going to be for shingles, for AC units, for doorknobs, for everything inside of your house. Everything's going to continue to get more and more and more expensive. And so I believe just because these areas are higher risk, they're going to factor in the high risk of those areas coupled with the rising cost. And so I believe that these rates are going to continue to expand further than what they're saying. Now, this company, what they say here is this is the same company that's producing that data, they're saying climate-driven population shifts and insurance increases are set to erase 1.4 trillion in American real estate value. Now, they say a comprehensive analysis by First Street, published today in its 12th national report, Property Prices in Peril, provides critical insights into the observed and projected effects of climate on the U.S. real estate market utilizing new peer-reviewed methodologies. In macroeconomic modeling, the report estimates potential 1.47 trillion reduction in unadjusted real estate value over the next 30 years due to climate. Now, they go on to say that simultaneously, migration induced by climate, such as extreme weather, wildfire smoke, and flooding, is anticipated to drive significant population redistribution, with 55 million Americans expected to relocate within the U.S. over the same period. So they're projecting 55 million Americans to relocate, right? Regions historically considered less populous, such as North Dakota and Montana, are forecasted to grow due to climate resilience. Climate is no longer a theoretical concern. It is a measurable force reshaping real estate markets and regional economies across the U.S. Our findings highlight the urgent need to understand how rising insurance costs and population movements are transforming the economic geography of the nation. And they say the study underscores a stark divergence in property values. High-risk areas are likely to experience significant devaluation, while regions perceived as climate resilient are poised to benefit from increased demand. The reallocation of economic activity has profound implications for local government revenues, with at-risk areas facing reductions in property tax income, while more resilient areas stand to gain. So for me, what I believe is going to be the move is investing in areas with low insurance where you can buy affordable properties that make sense. Now, these are the cheapest markets, top 10 states with the lowest insurance. You have Maine, New Hampshire, Vermont, Ohio, Idaho, Virginia, Indiana, Hawaii, Illinois, and Washington. So what I think the trend is going to be is I believe consumer debt is going to get worse. People are going to borrow more and more and more. They're not going to have a choice. And as they're borrowing more and more and more, and interest rates are continuing to rise, and homeowner insurance is getting more expensive, taxes are getting more expensive, people are going to be forced to migrate. And I think we're going to see a lot of capital flow into these markets to really capture this migration pattern. That's why I moved to Ohio. I live in Ohio now, and in 2021 I sold my place in LA. I was a landlord in Los Angeles, sold my place. I thought that it was going to become more problematic to be a landlord there, and I moved to Florida. I sold a place in Florida in November, and now I'm in Ohio. I'm not going anywhere. Ohio, I think, is there's a couple other states, but I went to Indianapolis over the last weekend, and a lot of people are talking about Indianapolis. You go out there, you get a beat up rundown home. It's $250,000 to $300,000, and you're renting it for maybe $1,600 to $1,800. Where I am, you're spending half of that, or even far less than that, $80,000 or so, and you're getting around the same rents. So I think we're going to start to see a really big shift towards these markets, towards these affordable markets, and I think this insurance crisis is going to really expedite that shift. What do you think about this entire situation? Where do you see all this going? How high will homeowner insurance rates go in these high-risk areas? Let's have a conversation about this below. If you'd like to learn more about what I'm doing, go to singlefamilyinvestors.com. That's singlefamilyinvestors.com if you have $100K or more in liquid cash. Catch you next video.